Coming up, the headline inflation rate falls to be within the RBA's target band. Grocery prices are down at Woolworths, and the US elections impact on Bitcoin. All of that next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 30th of October 2024. The Australian share market fell today by 0.3%. We'll have the details with Josh Gilbert from eToro soon, including where he thinks there's still some opportunities on the share market. But first to today's economic news, where the headline inflation rate, according to the Bureau of Statistics, fell to an annual rate of 2.8%. That's within the RBA's target of 2 to 3%, but the underlying rate is above that at 3.5%. To explain all of that, I spoke earlier with David Bassanese, the chief economist at BetaShares. David, so the headline inflation rate is now within the RBA's target band of 2 to 3%. Surely the RBA is happy about this.
Well, probably not over the moon, I would say. I mean, the real story here is the headline numbers are being distorted by the big drop in electricity prices. We had something like a 15% decline in the quarter. So that's helped lower headline inflation by about 0.3 just in the quarter. But the big story is, underlying inflation is still too high. It's at 3.5%. It did come down. It was in June, the year-on-year number was 4, and in September it's dropped down to 3.5. So yes, moving in the right direction, but still, too high, I think, for the RBA to be, thinking about rate cuts anytime soon.
What is it in that underlying read that's worrying? Is it that persistent services inflation that we're seeing?
Yeah, look, if you compare inflation today to what we had prior to the pandemic, the two things that still stick out are services inflation, things like insurance costs, in particular, healthcare costs, and also housing costs. So the housing sector, and we've got, rent inflation still pretty high. So it's housing costs and services broadly defined that is holding up inflation. Goods inflation in Australia certainly down and back to sort of pre-pandemic levels.
How does Australia compare with the rest of the world?
Inflation in Australia hasn't come down as quickly and as far as it has in some other countries. In the US, for example, the similar trim mean measure I just checked this morning is at 2.7%. Their core consumption deflator, the one they really focus on, is also at 2.7. So it's come down more in the US. More competitive market, I think it is fair to say. There's been more labour market softening in the US. Wages growth has come down. Other countries have had decent declines in inflation as well, but they've had a weaker economy, recessionary conditions in countries like the UK, Canada, and even New Zealand. So yes, they've got inflation down, but they've had bore some costs as a result. But the big one is the US. They've had really nice decline in inflation, and the economy so far has been holding up pretty well.
Since you mentioned inflation, we've got the US presidential election coming up very soon, and there are those concerns that whoever wins, there'll be some stimulatory measures. Could that be inflationary, and could that flow through to the rest of the world?
Yes, it could. I mean, obviously under Donald Trump, the big concern is if he jacks up tariffs. He says it won't, but it will increase prices in the US. And, fiscal, and tax cuts adding to consumer spending. So there is a risk of inflation, bouncing back a little under either candidate. Probably a greater risk under Trump when you compare the two policies. But the big yawning budget deficit in the US is still a major issue for markets, and that'll be something that markets may well focus on after the election.
So all in all, what do you think this now means for the RBA? I think it's meeting next week. It'll meet again in the middle of December, and then it's pushed out into February next year. When will we likely see an interest rate cut?
I don't think on today's numbers we can expect a rate cut before Christmas. So certainly a rate cut, this year is out of the question. I mean, if we had a really nice, surprisingly sharp decline in inflation today, there would have been a chance of a rate cut. But I think that's been is now out of the window. February is still a chance, and they'll wait for the December quarter CPI that comes out in late January. So I think the first opportunity for a rate cut will be in February. But again, if underlying inflation is still around 3.5%, even that may not be enough for the RBA to cut rates in February. So the risk is it may take a little bit longer than early next year. It could be mid next year, but it really just depends on the inflation number.
David Bassanese there, the Chief Economist at BetaShares.
Now, Market Day on the SBS On the Money podcast.
And the Australian share market fell today. The S&P ASX 200 down 0.8%, 8,180 points. Stocks like Woolies and Coles leading the declines. It follows a bit of a profit warning from Woolworths saying that numbers aren't expected to be as good as expected. With that and more of the day's market action, I spoke with Josh Gilbert, market analyst at eToro.
I think there's so much for investors to sort of really consider at the moment, especially this week. We had that inflation print today here in Australia. We've got more data later in the week, including retail sales. That inflation print did come in, maybe not as the market may have wanted. We've got hordes of AGM sort of flowing through as well. If we take one look overseas as well, we've got the biggest tech names handing down their results this week as well. So I think there's plenty for investors to sort of focus on. And I think there's a little bit of risk-off mentality coming through as well. Look to the US, we've got PCE inflation, we've got GDP data, non-farm payrolls on Friday as well. That's been a recent source of volatility also. So I think that, look, we're also set at record highs as well for a lot of assets, a lot of markets sitting at record highs. So we're navigating a difficult period, but I think that, investors are doing it very well at the moment, given what's being thrown in front of them. But yeah, really today, I think it's that, that data we're getting from a lot of these companies that are reporting, but also that inflation print that we got also.
I just spoke to David Bassanese from BetaShares, who was telling me that he reckons the next rate cut will now likely be next year, following the inflation numbers out today, which I already spoke about in detail. He reckons at least February, if we see services inflation come down. The Commonwealth Bank today, it has pushed back its rate cut call from December to February as well. But what's the market thinking?
Yeah, look, the market has really pushed back even further than that. So it's gone back significantly. So looking at sort of market price, and the market doesn't see a full cut from the RBA until May next year. So that's sort of really also in line with sort of the stance that Michelle Bullock and the RBA have sort of ultimately taken. Again, I would probably sort of be in a similar category, that maybe that May number does feel a little bit far-fetched. And I think looking around that February sort of region is probably when we get that first cut. But if we look at those headline numbers today, really when we look at it, you go, okay, great, inflation falling back into sort of target. We are sort of seeing it fall, but really it was that trim number, which ultimately is the core number. It takes out volatile items. That needs to keep falling quite significantly. And we also need to see the labour market show signs of easing further. Those numbers continue to be pretty volatile also. So I think today's figures sort of really show why I think the RBA and Michelle Bullock have taken a tough stance so far. But as I say, maybe markets are being a little bit too hawkish on it. So I think February is maybe where I think that we sort of sit in the middle of that first rate cut.
One area where we talk a lot about inflation is when it comes to food prices, and we know that supermarkets have really been in the headlines of late. What did Woolworths say today about how it is seeing inflation play out at its stores?
Yeah, well, look, actually, having a look at the numbers today in that CPI print, we're still seeing food prices actually rise quite significantly. It was up 3.3% over the last sort of 12 months. So that's pretty significant, and a lot of that coming from fruit and vegetables. And again, that's a big part of, the Woolies' is products. And some of those other food products as well, we have had some issues in the likes of like chocolate and cocoa prices, moving higher and things like that. And that's sort of really affecting in terms of margins and sales. So what we're having to see from Woolworths is they're having to discount items. They're seeing a lot of sales come through because they're discounting items, but that's affecting their margins. So it's a bit of a balancing act really for businesses like Woolworths and Coles. They've come under a lot of pressure over the last sort of 12 months from governments, from the ACCC, but really their margins are actually wafer thin. These companies don't actually make a whole lot of money. We're talking a couple of percent in terms of margins. So when inflation sort of does remain high and they're under a lot of pressure, it is going to take a bit of a hit to their bottom line. And that's ultimately why we're seeing their shares fall quite significantly today.
This time next week, we've got another key macro event, and that's the US election. How will it influence the market?
Yeah, look, I think it's already, sort of really having an impact already. It's that sort of uncertainty, if you like, because we're probably going to see volatility increase. And when we have that uncertainty, markets don't like it because markets hate uncertainty. It changes because we'll have policy decisions made by, whoever is elected. And then obviously, the Congress that we get after that as well. That sort of shapes how, financial markets sort of play out. But sort of looking at data we've had from history, there isn't actually a huge difference in market returns from an election year to not. If anything, we've actually seen that the S&P 500 has actually returned more, so about 8.7% in an election year compared to about 7% outside of that. So I guess we can also look at, depending on who is elected, there's going to be different benefits for both. If we look at Kamala Harris, more focused on the likes of like energy stocks and industrials, whereas Trump, we may see a bit of a broader market focus, and that could help companies that earn dollars in the US, given that he's looking to reduce taxes. That should help small caps as well. But on the other side of that, Trump may have, from the geopolitical side, that could cause a little bit of uncertainty. Anything directly related to China could come under pressure. But look, I think it's going to cause a fair bit of volatility nonetheless.
Is it flowing through to currencies, the likes of commodities and Bitcoin? Because I note that the Australian dollar is at about a 10-week low against the US, and gold's at records.
Yeah, exactly. Yeah, look, Bitcoin is, it's having a big effect, and gold, absolutely. Gold prices keep rising. They are sat at sort of record levels. On that, as I mentioned, that uncertain view, gold is seen as that sort of safe haven asset. And it's also seen as that asset that is set to benefit if we do see the dollar fall as well. And also, as I say, just coming from that massive week that we do have over the next couple of weeks, and on the view that if rates keep falling, gold prices should do well. Bitcoin, though, that's essentially pricing in a Trump win. We can look into sort of the polling markets, the betting markets, if you like, that has Trump pretty significantly ahead, and he is the clear Bitcoin advocate out of the two candidates. So what we've sort of really been seeing from the likes of Bitcoin is a quiet but sort of steady bullish momentum. We've kind of seen that brewing over the last few weeks after what's been quite a long period of months of consolidation. The last time we had a rally like this was when we actually saw Biden pull out and then Trump again take the lead in the polls. That was the last time we sort of really got a rally. So combine that with and the appetite for Bitcoin growing from an institutional level at a time when interest rates are falling, which allows investors to take on a bit more risk. It's all sort of making for a great mix for Bitcoin right now.
And finally, where do you see the opportunities for investors at the moment?
Yeah, look, short term, I think right now it's hard for me to look past big tech. I was just sort of analyzing the results from Alphabet this morning, so the parent company of Google, and their results were absolutely stellar. They beat pretty much across every single segment of the business, and I think that could set up what could be a good week for that Magnificent Seven. And I think if we do get solid earnings from the rest of that group, so the rest this week we have Microsoft, Meta, Amazon, and Apple. I think if they all report strong results, I think that will put those stocks on track to keep driving higher into year end. They are spending huge amounts of cash right now, but they're making even more on their bottom lines, and growth remains solid. AI is a big driver of that. So I think those companies, we can't look past them as we head into year end, particularly after, through that sort of middle period of the year, they did see some weakness. So I think investors have a little bit more confidence in those big names now if they continue to deliver this week.
That's Josh Gilbert there from eToro. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.